trading firm Akuna fined $1.28 million for manipulating the VIX. Let's talk about that and more coming up next. Short Vol Show Live. All right, so enough of that Joe Rogan ripoff. And this article came out thanks to our buddy at Wall Street Journal, Gunjan, and I think she was the first to break this story. But case has been going on for a while, although I'm not sure that if they had mentioned who they were going after. Akuna is a market making and trading firm. It was kind of like categorized by one company as being a crypto firm. I guess they dabbled in crypto, but this has nothing to do with crypto, so I'm not sure why it was on a crypto website. But and I was just looking through, which is always fun, Glassdoor, to see what people had to say about Akuna, who probably got fired from them and stuff like that, because that's always fun, right? Seeing people trash talking about somebody. So I found this Akuna. Let's see what we've got here. Truth about Akuna. Some good people in a culturally significant area, which makes going to lunch nice in a spacious office. Good experience with high-frequency trading. Cons. Long hours, tons of pressure, workspaces average, no free lunch or snacks, no free drinks. Now, if I was working for a major trading firm, would I be expecting free snacks? Probably not. That sounds kind of weird. Nepotism. CEO and CFO are married. CEO, COO, head of trading, and CEO are best friends. Be careful if you have an opinion that disagrees with them. They will not like it, and you will not rise in the company. So, okay, well, that sounds like most small companies. So Akuna manipulating the VIX. We've talked about this before. How did they do it? Well, for that, let's first look at. I'm going to read this article just to give you the groundwork here. Here we go. This is from Bloomberg. Suspicion has been swirling for years that something fishy is going on in Wall Street's benchmark index for stock volatility. And let me stop right here and say, like, expiration, we see this stuff move around. In fact, last expiration, we saw the VIX number just pop all of a sudden right before expiration. It just moved way up. I mean, it wasn't way up, but it moved up significantly. It was definitely noticeable, and we've seen it where it was way more noticeable before. And like I said, this case is from a while back, so whereas this case is not about that particular day, this stuff has been going on for a while. Cboe Global Markets, which owns the VIX, fined high-frequency trading firm Akuna Securities, LLC. And let me go and check. Okay, so Business Conduct Committee of the Cboe Exchange, decision accepting letter of consent. Richard Bruder, chairman of Business Conduct Committee. I know who that is. I know Richard Bruder. Okay, Securities. They violated. They were violating the prices with the quotes in the order book for SPX options. It says, during all relevant periods, Akuna was an exchange trading permit holder approved to conduct business on the exchange as a market maker and therefore consenting to the jurisdiction of the exchange. During all relevant periods, Akuna was acting as a registered broker-dealer. During all relevant periods, just and equitable principles of trade, adherence to law were in full force and effect. VIX options and VIX futures are based on the Cboe Volatility Index. And it talks about how those work. The VIX methodology used to calculate the SOQ initially selects a universe of out-of-the-money SPX put and call options. So the SOQ is the prices that the VIX is based on, the settlement is based on. Akuna, as part of its trade strategy, participated in the auction conducted on the SIBO options used to generate the SOQ by submitting strategy orders composed of a strip of certain SPX options in order to flatten Akuna's exposure from its expiring ViX options and futures positions. On 3 expiration dates, between November 2016 and November 2017, Akuna submitted strategy orders. In addition, Akuna submitted minimum increment SPX option orders to increase the likelihood that certain SPX option series that were part of its strategy would be bid and therefore included in the SOQ. So what they're talking about here is if there are 2 strikes in a row of out-of-the-money options that have a 0 bid, then they are not included in the calculation. And anything below them, farther out of the money for options, is not included in the calculation. However, you could put in like a small bid for some of these things, and all of a sudden they're included in the calculation, and it changes the price of the VIX dramatically, and all you have to do is a small thing, put these bids in. As a result of this conduct, the final VIX settlement values on those 3 dates included certain SPX options series that otherwise would not have been included due to the 0 bid rule described in paragraph 6 above, which is what I was talking about. And let me just say it once again. It's going to include, out-of-the-money option strikes are included in the VIX settlement price, and until there's a space where there are 2 out-of-the-money options in a row that are 0 bid. There's no bid for them. After that, it just cuts it off, and that's the top. But if you start putting really small bids in these other strikes, all of a sudden they're going to be included in the final calculation, and it's going to raise the price of the VIX. And that they're saying that they artificially manipulated the situation by putting bids in these strikes to extend the number of strikes that were included in the calculation of the VIX, and thus raise the price. The acts, practices, and conduct described constitute a violation of exchange rules by Akuna, in that Akuna failed to supervise the trading activity of its associate persons so as to assure compliance with Exchange Rule 4.1. As a result of the conduct described above, a total fine of $1.275,000, of which $854,250 shall be paid to the SIBO exchange and $420,000 shall be paid to the SIBO futures exchange. They got fined $420,000. Wow, how trippy. A total disgorgement in the amount of $6,726 shall be paid to SIBO futures exchanges and a censure. Subject has acknowledged that it has read the letter of consent and that no promise or inducement of any kind has been made by the exchange or its staff, and that the letter of consent is voluntary on its part. And they accepted no wrongdoing in this situation. So let's get back to the article. Okay. The firm neither admitted nor denied the allegations in a disciplinary action announced Friday. John Harris, Akuna's chief operating officer and chief financial officer, declined to comment. Akuna's website describes the firm as a proprietary trading firm specializing in derivative market making and sophisticated modeling with a commitment to cutting-edge technology. While allegations of VIX-related funny business come in different varieties, including flat-out rigging to influence the futures market, Akuna's transgression didn't amount to manipulation in SIBO's view. The exchange has rules that are brought to bear when this is suspected, but they weren't used here. Well, that doesn't make sense. It certainly does. It certainly does amount to manipulation. I guess maybe they're saying it wasn't as bad manipulation as it could have been or something, but if you're artificially increasing the strip of options that's included in the calculation to raise the price of the VIX, and that's clearly manipulation. But, SIBO doesn't want to make a big deal of this because they don't want a lot of press on this. They want to kind of like just, limit the bleeding and limit the negative press that's going on through this. So let's go back to a paper that kind of started a lot of this stuff out, which was by this guy, John Griffin, from Texas, University of Texas. Just to give you some background, Professor John M. Griffin is currently the James A. Elkins Centennial Chair in Finance at the University of Texas McCombs School of Business. And he came out with this paper in 2015, which kind of got the ball rolling on telling people how stuff was being manipulated, and they're also alleging now that other people, once they read this paper, were like, oh, that's how you do it, and started trying to manipulate the situation themselves. So let's go through this paper. I don't want to go too in detail about it, but I don't want to get too much into like overly technical stuff, but let's just go through it broadly, and I think it will be meaningful to you. And here's the paper. Let me just check and see if you can see what's going on here. I'm kind of in the way of this. Let me move over here, the paper. All right, so here's the paper, and I'm going to move myself kind of sideways and out of the way here for a bit. I don't need to show you a whole lot about this paper. I do want to show you one chart coming up in a few minutes, but until then, I'm just going to start reading part of this. Let me see how I can do this. All right, so I'm going to just duplicate this so that I can put one over so you can see it and so I can read it at the same time. Manipulation in the ViX. Blah, 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 blah. The Chicago Board Options Exchange Volatility Index is a widely tracked index that gauges the 30-year implied volatility of the market, often referred to as the market fear gauge. And I'm going to skip through a little bit here. Several interesting data patterns emerge. First, at the exact time of monthly ViX settlement, highly statistically and economically significant trading volume spikes occur in the underlying SPX options. Second, spikes occur only in the out-of-the-money SPX options included in the ViX settlement calculation and not in the excluded in-the-money options. Third, there is no spike in volume for the similar S&P 100 index, the OEX, or the SPDR S&P 500 ETF, SPY, options unconnected to volatility index derivatives. Fourth, if traders sought to manipulate the ViX index, they would want to move the prices by optimally spreading their trades across the SPX strikes and increasing the number of trades in the deep out-of-the-money put options consistent with the ViX formula. Trading volume at settlement does follow, that's my saying does there. Trading at settlement follows this pattern, whereas normally deep out-of-the-money options are rarely traded. So when it's not expiration, these options are rarely traded. But on expiration day, at that exact moment that it would be important to move them, they're traded a lot. It goes on to talk about V stocks here for a second, but I want to get back to, let me just fast forward here for a second. It talks about how you would like legitimately hedge your positions, and they're not seeing that happen. They're just seeing evidence of manipulation happen as confirmed by the volume. ViX mechanics. Options on the S&P 500 index are widely traded at various strike prices and maturities. Using the premium that investors are willing to pay for call and put options at various strike prices, observers can calculate the implied volatility of the market. Because of the interest by market participants, the SIBO formula calculates the ViX in real-time updates the index every 15 seconds using SPX options with more than 23 and less than 37 days till expiration. The settlement of ViX options and futures typically occurs in the third or fourth Wednesday of each month. The exercise settlement values of ViX futures and options is calculated using the auction clearing prices of SPX options in an auction called the special opening quotation. And that's what they were referring to in that ruling against the people, was that they were manipulating the SOQ, or the special opening quotation. I'll try to get this to the same page here so you can read along with me. The SPX's options auction clearing prices are used in the ViX formula to calculate the ViX settlement value at that point in time. Importantly, this SPX options series used in the VIX settlement calculations are ones that expire in exactly 30 days, normally on the third Friday of the next month. In-the-money options are not included in the settlement value. All the out-of-the-money options are included in the settlement calculation as long as the option is a non-zero bid option. An option considered a zero bid if there is an option is considered a zero bid if there is no remaining bid in the option after the settlement trades are cleared. Moreover, the tails of the options trade on both the put and call sides are cut when two consecutive zero bid options are observed. All of the deeper out-of-the-money options are excluded. So what these guys in Akuna were doing were they were putting small bids in a bunch of other options so that the part where it would usually stop at a certain strike where there were zero bids above there, but they kept putting these mini bids in all these other strikes so that these other series would be included, and this was raising the price. And it didn't cost them very much to put these bids in. And but it was able to manipulate things to a great extent. So what they would do is they would buy VIX futures, which was thickly traded and easily liquid to get out of. And then they would go ahead and put bids on these SPX options, which were illiquid and thinly traded. So would cost them a very small amount of money to manipulate the thinly traded options, while they had gotten long ahead of time the thickly traded options, those being the VIX futures. And then they were able to move the market with these small bids. Do the VIX derivatives have characteristics that make manipulation possible? Below, we examine specific features of the VIX in relation to section. All right, let's see. The VIX derivatives are cash settled. Therefore, if the VIX settlement value deviates from its true value, the VIX position will automatically be cashed out at the deviated price. Third, the settlement occurs within a short period of time based on the SPX options pre-open auction. Large buyer-seller orders for the out-of-the-money SPX options in the SOQ auction can affect the VIX settlement value by changing the options auction clearing price through the demand-supply equilibrium. This means that there's a finite period of time where the cost of manipulation must be incurred. Although not all three conditions may be simultaneously needed for manipulation, the occurrence of all three potentially provides a ripe setting for profitable manipulation. All right. And it has a section on data, and I want to show you this one chart, which is really it's really the nail in the coffin to me, and really right there is a picture of the VIX calculation. And it discusses how certain strikes are more important for the calculation, and they noticed data on those particular strikes was they were being traded more right around the time of settlement. But I want to go to this last chart here. All right, so if we look at this last chart here, to me this is really what the most damning thing. I don't know if you can see the colors, but there's two lines here, okay? The one that I'm pointing to right here that has high volume on the out-of-the-money options and then lower and lower volume, that is just on VIX expiration. All of a sudden, they're interested in these way out-of-the-money puts, and in a normal day, it basically is what you would think of for any options. That being at the money is the most active strike, and then slightly out of the money puts are very active, and then it kind of goes down from there. The calls are not very active. But on expiration for the VIX, you see, not a whole lot of activity in anything except these completely way out of the money puts that nobody really cares about most of the other time. So it's the beginning portion of this chart right here. There's this huge It's huge discrepancy right on expiration, and that is really the damning thing that really shows that stuff is being manipulated here. I know this is a little technical babbly, and you can get into more detail on this, which I didn't really do, but basically this is what Akuna was doing, was they were manipulating the market to make money on expiration day. And people are still doing this now. We know because we see it on expiration. We see stuff pop. They're being fined from, years ago, and it's perfectly likely that they've made multiple times of what they're being fined, just even maybe in one expiration. So, typical Wall Street, giving itself a slap on the wrist and sort of allowing this stuff to continue, trying to kind of sweep it under the rug. A fine is given from time to time so that they can show that they're supposedly doing their job, but these guys didn't have to admit any wrongdoing, and the SIBO, is very quiet about it, and if it hadn't been picked up by these major news services, nobody would even really know what happened. So there you have it. Thanks for watching. I hope this was enlightening to you, and I guess we'll see you next time that we have a broadcast of the Short Vol Show live.